Hello and welcome to BISP Solutions. We are going to continue our learning of QuickBook desktop sessions. Okay, so we are going to continue us sessions. So now in yesterday's section, in previous sessions, we have completed about the fixed assets. Now it's left out what is long-term liability. So along with one fixed assets, we will continue to know how to amortize the liability. So Mr. Dawson asked about how to record the assets and how to record the assets which is already exist in the business. So there is a third way also, that when we finance fixed assets, and how can we pay a loan amount. Okay, so now Mr. Gabby is telling him about that if you finance a fixed assets, how this transactions are going to be recorded. Okay. So now we are going to record the home financing and fixed assets and paying the loan amount. Okay, so now how will be record this in the application? It will be recorded like this. Okay, it will be recorded like this. So now we are going to record it. Okay, so if you see that in QuickBooks we have three ways to record this assets when we are financing from a loan. How will it will be there? So now first we will create the first way is to create a general entry from the general option. Okay, how you can go to the company and you will go to the make general entries, and you see this. Okay, we are going to make general entries. Suppose we are buying these assets on 1st of February 2024. What is the account is, so like suppose we are buying a delivery vehicle. Okay, delivery vehicle for a delivery expenses. So we don't have delivery vehicle here. We will create a new here. We create a new fixed assets. Let's get a continue, give a again. We forgot that what is the fixed assets. We are getting 35,000. Okay, so again from the general entry, here we are going on 1st of February 2024. We create a new account, that is the fixed assets. Because we are recording a fixed assets, we will give this, what is the account name is vehicle. We will write this delivery vehicle. Okay, and we just click save and close. So how much amount we are getting this? We are getting this 25 to like 25,000. Okay, so the delivery vehicle is of $25,000. We shall give a memo. The name is purchased a vehicle. Okay, as we there, it's come up that what, suppose you are paying the amount of 2,000. Okay, you of course you paying the amount of 2,000 from the bank account. Okay, and you will give down payment paid. And now what next? The next is the loan account. There is not a loan account. We will go and create a loan account. Again from there we'll create a loan that will give you tracks the principal. If not, you should come and select this other long-term liability. You select continue, it will show you a long-term liability. Again we have to manage this account, so we have to be very careful while doing this. Okay, suppose, okay, again, oh no, okay, we will give this add new, give a loan account. We can create other long-term liability. Continue, we give the name to, that is 7,000. Okay, we give the name, account name is auto loan account, auto loan. Okay, and we can click save and close, and here you can see this, that, and you can see when we click save and close, and now you will see this, that we have just buy the fixed assets through the loan by paying. Again on the trial balance you will see, you will see that delivery vehicle is comes up here, and a loan account, auto loan account of 23,000 is credited here. When you click double click, you can see the transaction here. Okay, and what other effect of this loan will gone, the other effect is gone to the first of all in the uh, balance sheet. You will see on the balance sheet here, you will see on the balance sheet that delivery vehicle of 25,000 has been created, and what does they also created, the auto loan of 23,000 has been created here. Okay, so when we pay out, this balance will goes to less, but what happened, delivery vehicle will there is getting decreased by the depreciation. Okay, so this is the first method to record your financing of a fixed assets. So what is the other, first what was the next method? We will first delete this transaction. Okay, we will first delete this transaction. First we will delete this transaction. Okay, we will delete it, the transaction. Okay, and let's see the on the trial balance, is it okay or not? Yes, there is fine. So now the next method is to write a check separately. How does this happen? So this happen, first you have to write an entry. How does, first you will make a general entries. So this is the second way. This is the this is the first way. Now this is the second way to record a financing assets. So again, from the company make general entries. You will make a general entry on 1st February 2024. Again, if there is a delivery vehicle, if it has not been deleted yet, take a delivery vehicle of 2,25,000, give a memo, and the auto loan. Yeah, auto loan, we have created a loan account here. Now by this you will enter and click save and close. Okay, so now on the trial balance you will be see this, that the 25,000 delivery vehicle is comes for the first time, and it's supposed that auto loan is also being created. Okay, now the next is on the balance sheet. You will see also on the balance sheet also you will see that 25,000 delivery vehicle is comes up here, and 25,000 auto loan is comes up here. Suppose on that same day you just paid the down payment. Okay, you just the down payment, then what happens? So for this you will go and write a check on the same day. You will write a check from this account. You will just add a new vendor. If not there is not a vendor, you will just create a auto loan company, the vendor name, whatever the name you know you created. Okay, the vendor is there, and on the expense account you will credit the auto loan. You will create a auto loan account. Okay, with what amount? The amount is 2,000. Like you paying the amount of 2,000. Okay, so when you click save and close, and you will see on the first on the trial balance, you will see this, that auto loan is decreased by $22,000, and that is 23,000 as we have already paid the down payment, or you can say the first installment, as whatever as this needed. And on the same balance sheet you will see this, that auto loan is credited to 23,000. Okay, so now we move on our third method, how to how to record a transaction, how to record a fixed assets through financing. Okay, so this is the most complex and important method, so be careful. First we will delete a check we have created. First we delete a check that we have created. Okay, so we will click delete the check. Okay, we create this 25,000. Then we go on the company general account, we will delete that entry as well. Okay, click on find, give the entry number 17. Okay, delete it. So now you will see. Okay, so just close all the windows. So now close all the windows. Okay, so now what is the third method? The third method is to write a check. How does this happen? Here you will see this, we have make a general entry and we have just write a check as well. So how this transaction is different from there? Because first we make the general entry there, then we have write a check of a down payment, but on here we will write a check, then on here we will write a check to record all the transaction, to record a transaction. So on the banking option on the right check, you will create it thus. Yes, it is going from here. This is of course, select the auto loan company if not created, that vendor, select the auto loan company. Okay, now suppose you are going to write this 20,000 here, 2000. Okay, you just check this, but here you will write item first. Here you will create this. If you have an assets, you can write it there. The asset is not available, so you will go and create your assets. Okay, asset name is delivery vehicle. Okay, again you will create a here, there is a delivery vehicle is already there. Okay, you select this, purchase, give the date, that is of 1st February. You are buying of 25,000 delivery vehicle. You just okay, and you click on okay. Okay, so now your delivery vehicle is comes up here. And now what happened here, this is here happen is that you create the auto loan, so you have to give the minus 23,000 to record the transaction. Okay, to record this transaction, it of course we have to give the expenses on auto loan account here. Okay, so when you click save and close, and what will you see that on the balance sheet there, on the trial balance, you will see that delivery vehicle of $25,000 and your auto loan is automatically comes up 23,000 here. Okay, why? Because 2,000 is the down payment that is gone from here. Okay, so now what next? The next thing is on the report of a balance sheet. When you see on the balance sheet, you will see the amount, the numbers is the same what we expecting from previous two methods. Okay, so this is how it is created. And now what else it happens? Yeah, you are just thinking, alright, yes, come on, think it. Yes, on the cash flow, you will see on the cash flow, you will see on the cash flow as well. Here the 23,000 auto loan has been created here on the financing activities. And what does this happen on the delivery vehicle? There is a 25,000 of the delivery vehicle is also created. So this is how we record the the assets through financing. Yes, now what happens on next when we pay, when we repay the amount? Okay, for this first we have to create a amortization table, or you can create it by your sense, or you can contact to your accountant. Okay, how does this amortization created. Suppose here you will can see that we have a principal amount of 25,000 and we just repay the down payment of 2,000. Okay, and we finance it 23,000 to 23,000. Okay, the interest rate is 20%. The life of the asset is 5 years. Oh sorry, we have taken the finance for 5 years. Okay, that is equals to 60 months. Okay, a monthly interest rate is 1.67%. So as we all know how to calculate the okay, so when we calculate by this, when we will be getting a 609.87 dollar is that we are going to pay per month. Okay, okay, that we are going to pay per month. Okay, so the due date, when we are paying the due date, the due date will be on last day of the month. Okay, you can just click that thing. Okay, we are just paying on the due date on 28 February. Suppose it is highly considerable, we always pay the installment amount in the next month. So but we are taking the last day of the month. Okay, suppose on the 28th February 2024 we are paying this. Okay, so what is the monthly installment? Okay, what is the monthly interest? So what is the monthly principal and what is outstanding balance? Okay, so now here how what is the outstanding balance? Okay, so now here the outstanding balance is of course 23,000. Okay, so now how we will create the monthly interest? So this calculation has you already done here. So the monthly installment is of course 609.87 dollars. Okay, so now we are going to calculate the monthly interest. The interest will come up here. Here you give this with this interest. Okay, so you'll get the 384.10 if you okay, so now double click it because we have to fix this. We will click F4 and we just enter it. Okay, so now what is the monthly payment? The monthly payment is gone to from here. Okay, so the monthly payment is come to 225.77. and what is the outstanding balance is left? The balance outstanding is left is here. Okay, so when we click down, we have to fix this. We have to fix this. Okay, we fix this and we fix this. Okay, so now when we drag this, okay, so this is the first installment that we have seen here. Okay, so now the second this is the first installment. When you make this customization table, you will be able to see this. Okay, 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 yeah, we have just put the wrong formula. We will correct this the formula. So we will correct our formula. So suppose we are just doing this formula right now, some happen, so we'll continue a topic to make you understand. Okay, so this method is declining method. So now how we are going to record this transactions? We will record this transaction by going on the banking. We will write a check on 28th February 2000. We have select this bank on 28th February. So let's take 29th February. So what is the amount we are paying? We are paying 609.87. The amount. Okay, so what we will take, we will just make auto loan company is the vendor here. So the auto loan will be, what is the principal is there? The principal we are just paying is 225.77, and the auto loan is paying 220, and the interest expenses. So we don't have any interest expenses here, so we will create this interest expenses. Okay, we will add a new expense, continue, and we give interest expenses, and we click save and close. The balance amount, what is the balance amount is left? 384.10. 384.10. Okay, when we click save and close, and you will see on the trial balance, you will see that the interest expenses is comes up here 384.10, and the loan amount will decrease by this particular amount as we have calculated here. And what other the impact goes on the banking, on the reports, you will see the other reports on the profit and loss account. You will see that 384.10 on the expenses side will comes up, and the other posting of impact will goes to on the balance sheet. Here you see the on the balance sheet that 224.774.3 we have just been paid certain percentage of amount. A balance is gone low, is lower, of course, and the particular of that is gone to on the bank account, and the one more report will come generate. You can guess it. Here's cash flow, and we'll see on the cash flow what happens. The cash flow, when you see on the auto loan amount of the auto loan balances is also gone less. So this is how we record the transaction of fixed assets when we finance it, and this is how we repay this. Okay, so this is a method called declining interest methods. Mostly there is also a fixed assets fixed interest method, but in most cases the declining interest method is being followed. So I did explain you only this method. Okay, so we move to our next topic, and the next topic is a impairment of assets. What do you mean by impairment of assets? So So I am going to explain you through IAS 36 impairment of assets. IAS 36 impairment of assets seeks to ensure that an entity's assets are not carried at more than recoverable value. This means impairment of assets means impairment of loss. What does this standard says? This standard says that your carrying amount. What is carrying amount? The amount after deducting depreciation and all deduction related to the assets is known as carrying amount, is lesser than recoverable amount. What is recoverable amount? Recoverable amount is that the higher of the fair value, less cost of disposal and value in use. What is fair value? Fair value is that transaction between the market participant and value in use means when we create a present value of the cash flows, that whatever the amount is higher, it will be called recoverable amount. So a recoverable amount cannot be more than the carrying amount. It is always be lesser than the carrying amount, okay, with the exception of goodwill. Okay, so this is how the impairment of assets. So what does impairment of loss has been recorded in the transaction in the QuickBook? So in QuickBook it is recorded through journal entry. I am just going to tell you how we will record the impairment of assets. Here you can create the impairment of assets, suppose as an expense, the debit that particular amount, and you will credit it the assets which is being impaired. Okay, so the next thing is comes up in the mind when we are talking about the impairment of assets is the revaluation of assets. What does this mean of revaluation of assets? Revaluation of asset means increasing and decreasing of the value of the value of an assets. So when we are following the gap, okay, remember, just pay attention, I am talking about when we are talking about IAS, it is impairment of assets. But when we are talking about gap, what does it say? It says that US gap does not follow the revaluation of assets. It follows that what is historical cost and what is the fair value at that. So by this you will understand this. So IFRS allows revaluation of the following assets, okay, to fair value. If fair value can be measured reliably, inventories, property, PPE, and all this is marketable security. But this revaluation may be either an increase or decrease to assets. Under GAAP, revaluation is prohibited except for marketable security. So by this mean, when we are following the GAAP principle, we do not use the revaluation, but when we are following the IFRS and IAS, we use the revaluation. So impairment of assets and revaluation of assets cannot be followed parallelly. Okay, so this is how things gone. Okay, so now we all covered related to the long-term assets and long-term liabilities. How does we this? And now we move forward. Now Mr. Dawson asked about certain small features of the QuickBook. Okay, so he does ask what is the small features of the QuickBook. So he asks that suppose he want to make a file, so he can carry or he can carry or he can mail to other person, or he wants to load this file on the cloud. How can he do this? So Mr. Gabby told him you can do this by the portable company files. So he asked how, what is portable company files? So a portable company file is that we can create a file that we can take with us on portable media or email to another for use. For example, that we just like he asked to email a copy of a company file, it would send them a portable file which has a QBM extension. When they open the file we sent in QuickBooks, it's open the file and create a QB company file with the QBW extension from the data. However, changes made to a portable company file cannot be imported back into original company file without overwriting any changes made in the original company file. That we use a company file with while somebody makes changes a copy that we can later import. We can use the accountant review feature methods instead. So he has show me how you will create a portable file. So he told it from a file, from the file options you will create a copy. Here it will ask you the portable company file. When you click on next, it asks you to save this. Okay, suppose we are saving all data, we are saving all our data here. So we will create this here, and we create save this. Okay, and it will ask QuickBook must close and reopen your company file before creating a so you click on OK and you move forward. Okay. It will take hardly a time, and I will show you the QBW extension file. Okay, so it says that QuickBook has saved a portable file version for this company. Okay, so when we go and see a file there, here you will see the portable file. So you can just email this file, or you can save it on the cloud. Okay. Okay, so this is how the portable file can is been created. And now how we will send this file to through email or this, again from the file menu, send a company file, and you will ask the portable company file extension. When you browse this, and you will browse where you save this your portable QBW file. When you click send, and it will go whenever you want to send it. So this is how you can create the portable company file, and you can email and send it. Okay, so now the next small feature he asked about, that he wants to see the calendar where he wants to see that on which date you have done the transaction and what you have done on those particular day. So again, from the company option, on the calendar option, you will see the whole calendar of your transaction. Suppose here you will see entered 3 invoices. Here you will see we entered only 2 invoices. Okay, when you double click, you will see Halisha, and we have done this transaction. You will see 3 transactions. So it will give you the data on which date you have been created along with the transaction type. Okay, you can select a date whenever whichever date you want to see the transaction. So this is how you will use this calendar file. Okay, so now the next option is that we the QuickBook the QuickBooks give you the option of to track your income. Okay, how you can track your income? Again, from the customer options, you will see. I think the I think the income tracker is not available here. So for this we have to I think we have to first we go to the preference, and we have to here we have to create the tracker. So you can track from here also. You can create this and it will show you the tracker option. Okay. So I will just open a second company to show you how to track a income tracker. Okay. So I will going to open a next company to show you. Okay, here. So the income tracker is that where we can track our all incomes, and we can directly create it anything we want to do there. Like we can go directly to a certain report out there. Now again, I just open a second company here. Yeah, you can open the two companies at a time. Yeah, here on the customer menu. Yeah, on the customer menu you will see the income tracker. Here you will see the income tracker. Now here you will want to see all the estimates or a sales order, and what is the time and expenses, whatever you have been done through your customer, you will be able to see this. And if you can see here, you will select all the customers and you want the batch actions, the sales order, or you can email in the email batch. Okay, email batch. Okay, and you want to manage a new transactions, you can just go directly from here and you will be able to manage the you will able to write suppose you want to create an estimates. I just click on the invoice. Okay, I will deselect it and I will click on the invoice, and you will be directly goes through the new invoice, the window where you can create a new invoice. So this is how the income tracker works. So if there is a income tracker is available, there is also something something there for the vendor as well. Yes, of course, the vendor's bill tracker is also there. Here you will see the bill tracker. So when you click the bill tracker, you will see all your unbilled, unpaid bills and what bills have you been paid since then. So this is how you will see those trackers. And now these we are talking about the trackers. Suppose in some companies, when in some companies like in a service related company or consulting company or financing company, we always follow a customer. The customers we record customer habit at what he doing and how it will do. So it in the QuickBooks application, this tracking is called the lead tracker. We always lead tracker about a customer. Okay, so lead tracker is also there. So from here, as you see on the customer here, lead center, here you will see the lead center and what are the all your leads that you have been tracking your customer. Okay, you can create a new customer or you create all import through the spreadsheets. Okay, you can just import it from the spreadsheets and you will be able to see this, and you want to filter it that your leads is hot, warm and cold. So this is how your lead center is worked here. So now the next option is back to our old company. As the next option is how to move QuickBook desktop using migrator tool file. Okay, how to okay, so how, so your accountant asked that you want to move your QuickBook desktop file into another desktop without using a portable and this thing. So how will you do this? So we will do this from the file menu. You will go to the file menu and you see this move QuickBooks to another computer. From here you will just click and you will write a OK. So this is wants to apply. Okay, when you click I am ready, it will ask you the ID and password option. Okay, when you write the ID and password option, you will see after writing the password options, I am not going to move forward, but I have some screenshots to show you. After writing the password, you will see this window and it will show you that you can transfer only this you will only transfer only this amount of data, this bulk data. Okay, after you click on the copy data, you will, when the copy is done, it will take some few minutes. After this it will show you the green tick option that you are have copied all you need, and after this you will see the move quickbook.bat. so this file you can move from your desktop to another computer. So this is how the batch file can be moved. Okay, so now we back to our QuickBook again. So now we have discussed about, so we have now discussed about this. Okay, so now you can create a portable file, you can move QuickBooks to another migrator tool, you can email it. What happens when an accountant wants it? Yes, of course, you can create an accountant's copy file. Okay, and you can import as well. Okay, so after creating an accountant copy of a company file, we must import accountant changes back into a company file later on to restore full functionality to original company file. If a accountant send us a file, we open up a company file and insert the copy of changes an accountant gave on the removal media. Okay, so how does we do this? Again, from the file menu you will able to see by two method. When we create a copy, here it show you the create accountants copy. When you click on next and click again next, it will show you the date, divide your date, set the date. It divides the transactions that you can change from the ones your accountant can change. So you can please select a, suppose you will select the date, a custom date you want to select. You just give the cut off date of 1st May, and it will show you that QuickBook must close all windows to create an accountant's copy. You can create an OK, and again it will come up here and we create a copy of an accountant. Okay, it will take hardly a few seconds. Okay, it says that you have selected successfully. When you click on OK, here you will see on the heading of this Dream Multi Enterprise Accountant changes pending. So it is remain changes pending, and now you will see here that Dream Multi Enterprises QuickBook is comes up here. Okay, so when you go back there again, okay, here you want to send an accountant copy. If you here you can go here, these two options we are not going to that. Here it will ask you import accountant changes from the web. If you are just copying from the web, you just click this and you can move forward. If this accountant copies come up in a file that you have downloaded, it will extend you. Now if you want to change the restrictions, you can just click on the remove restrictions and it will you back to changes. Now we can add it and we can perform all the transactions we want to do like an admin. Before that we cannot delete it or alteration some features. So this is how this accountant's copy can be created. So now we have completed a fixed assets part and we have completed a small features part. Now we will move forward and we do how the sales tax is done in the QuickBooks applications. So thank you for joining this session and we will continue in the next session. Thank you.